Nilesh Shah joins in on the show right now. We also have with us Sachidanand Shukla from M&M and Mythili as well. Mythili, the governor was most worried how media and everyone else is going to tag and term his policy, whether it's going to be hawkish or dovish. What do you think it was?
Well, I would think it was somewhat more dovish perhaps than was warranted, given the fact that inflation clearly is a worry, and particularly if you look at core inflation. And the fact is that the RBI has been talking about withdrawal of accommodation for quite some time now, and even now we have surplus liquidity. So that doesn't quite gel with hiking interest rates. On the one hand, you're hiking your repo rate. On the other hand, despite your focus supposedly on accommodation, withdrawal of accommodation, you still have surplus. So that's a little bit of a puzzle. But what's interesting really, Aisha, is the fact that there's greater dissonance because earlier at best we saw 5:1 differences. Now we're seeing 5:1 on the rate and 4:2 on the withdrawal of accommodation. So that is interesting. And my sense is that on the first, it would be Jayant perhaps who's disagreed. And on the second, it will be both Jayant as well as Ashiba, both external members, because one doesn't expect internal members to disagree whatsoever from the RBI governor's line.
The take coming in, a quick check on the money market as we were talking about, a bit of reaction coming in for the rupee, which is actually weakened further. 82.45 is where we are at. Remember, pre-policy we were just around that 82.20 mark, so there has been a bit of weakening as far as the rupee goes. And even if you look at the 10-year yield, that has spiked a tad bit. We are now sitting at 7.29, and that compares with 7.22 that we were pre-policy as well. Though the equity markets are not doing much, the banking stocks are also not showing quite a bit of reaction. Let me welcome on board Ashwini Tiwari from SBI as well. He's the managing director, as well as we have Nilesh Shah. So Nilesh, wanted to come to you. As far as the commentary is concerned, there was quite a bit of stress when it comes to the growth in the Indian economy. He was talking about how manufacturing is doing quite well, farm is something the sector remains quite robust, and he also talked about rural demand recovering. It does seem like that everything is now pointing to the fact that rural demand is coming back.
So undoubtedly, growth continues to soften. RBI itself has revised growth target downwards from 7% to 6.8% for FY23. But these are unusual circumstances. Globally, there is a massive storm going on. And within that, India has so far done well. This is policy as per expectation. 35 basis point rate hike was discounted by the market, and hence there's little movement in yields. The guidance also is more data dependent, that depending upon the balls RBI will play, that's also as per expectation. So net policy as per market expectation, and the data going forward will determine what happens to the terminal repo rate and what happens to the liquidity.
Question that the governor referred to, in fact, in terms of the very strong double-digit credit growth, whereas deposit growth has not been so strong. So banks, strictly speaking, should be getting worried, but we are seeing liquidity still surplus. So what explains this apparent contradiction? On the one hand, credit growing much faster than deposit, at the same time, liquidity in surplus. Ashwini.
Yeah, so the liquidity surplus, as far as banks are concerned, that number is slightly lower than what the governor has said because of different adjustments made. And hence the pressure on deposit rates, as is well known, is there. And the rates have gone up in the last quarter especially. And they will again go up in response to these rate hikes. As the governor himself explained, the transmission has been happening better, both in loan side and on the deposit side. Because for a bank like us also, we are now almost 60% plus market-linked rates on the loan side. So therefore, the pressure on deposits will continue. And as you rightly said, the loan growth of around 19% or 20%, and for us also about 17% is pretty good. And therefore, if this continues, and we see no reason why this is not going to continue, the pressure on deposit rates will continue. So yeah, that is true.
So, Sachin, can I ask you the next question? That if loan growth is going to be strong and deposit growth, there will be pressure on banks to hike their rates. Do you think banks will give tough competition to Nilesh when he looks at the fixed income market and hike their rates so much that people turn away from bond markets and give him a run for his money? Sachidanand.
I don't think this is quite a problem for some of the larger entities. Yes, like in the K-shaped recovery in consumption, this is a phenomenon that you're witnessing everywhere in the economy, whether it is borrowing, whether it is investments. So some of the larger players, I don't think there is a problem in terms of liquidity. And I can tell you that systemic liquidity had moved to negative territory. And it's good that the RBI has mentioned that it is willing to take up or embark on OMOs because they had completely stopped it. And therefore, what had happened is there was a significant spike on the shorter end of the yield curve, and the yield curve had flattened. But I think from a larger perspective of, say, India Inc., I don't think this is going to be posing any challenges whatsoever when it comes to borrowing or even on the consumption side. The double whammy of, say, rising inflation, which was lowering purchasing power for consumers and customers, and rising rates, I think was a bigger challenge when it came to juxtaposing along with the global uncertainties. So I think what you say might be a problem in certain pockets, but by and large, I don't see this as a major negative. I do see a demand picking up across segments, and there are entities which are able to borrow. So yes, cost of borrowing may continue to rise, but the availability of liquidity to the right set of entities is not going to be a problem.
Nilesh, my question to you, that following from what Sachidanand said, is that if we are seeing strong services pick up, we are seeing strong revival of demand, both in the rural sector and for the services sector, that should add to inflationary pressures. But RBI has kept inflation estimate unchanged at 6.7 for the year. And also, where do you think bond yields will end? Because government still has to borrow a substantial amount of its borrowing calendar for the year. Nilesh.
Absolutely, Mythili. But in the bond market today, there are conundrums. We believe state governments this year potentially could borrow between 1,50,000 crore to 2 lakh crore less than the budgeted. They have surplus cash, they don't know how to spend money, and they may end up cutting their borrowing program. If that happens, the beneficiary will be the bond yields. The second conundrum with respect to liquidity is the small savings collection. By some reason, the small savings collection balloons in Jan, Feb, and March period. I believe last March, the small savings collection was almost 2 lakh crore plus. Now, will that be the same trend? If yes, then liquidity can get curtailed, and that will have negative impact on yield. And more importantly, market will be looking forward to 1st February. What will be the size of borrowing program next year? This year, RBI and market has been able to absorb enhanced borrowing program of the government securities. But we begin the year with almost 10 lakh crore of liquidity. Hopefully, in April, we'll probably begin with 1 lakh or 1.5 lakh crore. Now, will we have ability to borrow large size borrowing program? Answer is again debatable. So my feeling is that yields are going to go up and down based on global factors like US Fed. Where do they end terminal Fed rate? Second, where RBI ends their terminal repo rate. And third, the size of the government borrowing program in next fiscal. Yields will probably fluctuate between 7.25 on the lower side and maybe 7.75, 8 on the higher side.
775, 8 is pretty high, Nilesh. We haven't seen those numbers for a long time. Remember, it was not so long ago that the governor said that low bond yields are a public good. So clearly, the public has not seen too much good in that 6% that the RBI is hanging on to. But Mr. Devanji, what is your first reaction to the policy? Bang, as the market expected, you're happy, unhappy, or are there finer points to be dissected in the governor's statement?
No, I think it was more or less on the lines of expectation, which in terms of the hike was the only degree of hike was probably debated, but I think it came on absolutely as predicted at 35 bips, and also the policy clearly saying that if the inflation is not tamed, perhaps the measures would continue. So the estimation or the assumption that the terminal repo rate to end the year at about 6.5, I think it's on the course in that direction. So that's the what you call the obviously being a retail business guy, perhaps when the interest rates goes up, the questions which automatically come up is whether the demand for the retail loans will stay as buoyant as it is just now. And the real issue is, while the demand for credit is on the rise, the deposit growth rates are dwindling. So from that perspective, that could be some kind of actions which these banks we will have to take.
Yes, Virat, I think Kotak is big on retail, and most other banks, even public sector banks, which earlier used to lend to corporates and infrastructure, are now focusing on retail, which brings into the broad question is who's going to finance the corporates? Our bond markets are not sufficiently developed. Equity market, the activity is now increasingly only on the secondary market side. So my question both to you and to Ashwini is that who's going to be financing the corporates? And if corporates don't get financed, then there's not going to be much growth. Let me start with you, Virat.
The SME sector has clearly shown the buoyancy for the demand for the money, and all the banks have perhaps kept the pace with meeting their requirements. So I think as far as the SME is concerned, I don't see that as an issue as of now. Okay. As far as the large corporates is concerned, the dynamics are very different. Perhaps to what you call a rated credit, I don't think there will be any issue for banks to come forward and lend. That from that perspective, I would view it in that sense. So it is still not doomsday. Means banks are willing to lend. Perhaps the demand from the corporate side for willingness to make the investments have to keep pace with the desired expectation from the economy.
I have a question to you, because what Virat said is that the SME sector is doing quite well. But what I understand really from the market is that the SME sector hides a large number of NPAs, which haven't really come to the surface precisely because the kind of concessions that government had rightly accepted in the past. So there's a lot beneath the surface. So my first question is, would banks be willing to continue to lend to SMEs, given the fact that we still don't know the full picture, really, number one? Number two, in the case of SBI, for instance, there was a marked shift towards retail. Do you see that proportion shifting once again towards corporates rather than retail? Ashwini?
Yeah, so if you see the past 2 years, the corporate investment was muted, and therefore our limits to corporates were not being utilized. Even the sanctioned term loans were also not disbursed to the extent we would have liked. Now that has come back, and limits are getting utilized. Fresh proposals are also getting sanctioned. So what has happened essentially is that the retail side growth continues at the same pace. It has not increased dramatically, but the corporate utilizations have improved for us. And that is why you see the overall number for us excess of 15%, which is what we talk about, 17-18% last quarter, and a similar number may be expected this quarter as well. So therefore, for this is largely the result of corporate drawdowns. And therefore, we are supporting corporates where required. And as Divanji has said, that basically the underwriting standards have improved, and we are no longer willing to give loans to corporates whose ratings and all and are not very good. So because of the underwriting, the threshold is slightly higher, but support is continuously there. On SME, our support continues. In fact, our book has grown well in the last 2 years. On the health of the portfolio, while GECL, the emergency line which was given, did support a lot of SMEs. And now that the repayment of that has started, what we are seeing is that there is not a dramatic increase in NPLs for us in the emergency line to MSMEs. So we think that the portfolio health is pretty good, and it is contained. Whatever delinquencies were expected have not materialized.
Portfolio health continues to be quite robust. No concern as far as the asset quality is concerned. But let's take a look at the markets as well, because there has been a material slip as far as Nifty Bank is concerned. Almost 200-point slide coming in. When we started off, we were at around 43,300. It's now at the lowest point of the trading session, around that 43,100 mark. Even if you look at the Nifty, that's seen a slide of almost 40 to 50 points. And names like Federal Bank, Kotak Mahindra Bank, IndusInd Bank, these are the ones which are sliding quite a bit, and HDFC Bank too is trading in the red territory. Talking about the yields, because it spiked quite a bit. In fact, we are now staring at 7.32 when it comes to the 10-year bond yield. So, and an increase of almost 10 basis points there. And as far as rupee is concerned, a bit of a weakening happening. 82.50 is what we are staring at. So 82.48 is where we are at currently in terms of the rupee prices. Let me welcome on board Mr. Vijendra Srivastav, CIO Fixed Income Sundaram Mutual Fund as well. Hi, Mr. Srivastav. Good morning. Thank you so much for making time and speaking with us. 35 basis point largely on expected line, but the commentary that the RBI governor gave in terms of calibrated action going forward, that they will be nimble and flexible, does that tell you that going forward as well the pace of 35 basis point can continue and it's not end of the road as far as the rate upcycle is concerned?
Thank you. Good morning. Thank you for having me on this channel. I think if you look at it and try to remember where we started, I think we started on back of Federal Reserve raising the rates. So I think it's still dependent on what developed market central banks do. And 35 basis point, I think the only thing is that the market expectation in this policy was of a kind of indication of a pause sometime near time. I think that has not happened. It is very, very clearly they have not changed the stance and they have not reverted to neutral. People were expecting, market participants were expecting a neutral guidance. And I think that the voting in the monetary policy committee has been to that light. We can clearly see once we have the documents with us, this stance has been voted 4-2. Most likely it is Professor Verma and Dr. Goel, which have voted against the stance, and they must have wanted a softer stance. I think market was also anticipating that after the rift in the minutes, which we had seen. I think on that count, I think our opinion is that RBI has been right in fighting inflation. That is their primary task. And they've alluded to the strength in the economy to keeping that stance. I think that is something which is critical at this point in time, because the action which needs to be taken at this point in time is dependent on both growth and inflation. Inflation is a bugbear right now in the market, and need to look at it at this current juncture. I think the credit offtake has been pretty strong. All the high frequency indicators are pretty strong. And barring the global development which is happening right now, on that count as well, it's the largest economy in terms of the US. That's pretty robust as of now. Obviously, the leading indicators are showing some signs of weakness, and that could play out in some time. But having said that, I think India is doing pretty well, and on that context, keeping inflation under control becomes a priority, not to have a second order effects on inflation later on.
Mr. Venkatraman, how does the policy affect a bank like yours? And secondly, are banks in a particularly good sweet spot, which is partly why it's being reflected in the stock market also, valuations, because interest rates on the lending side get passed on almost immediately, thanks to RBI's insistence on benchmarking it to external benchmarks. Whereas on the deposit side, since you have contractual obligations and the interest rate hike affects only your new deposits, not the earlier ones. So does that put banks in a sweet spot? How does it impact a bank like yours? Mr. Venkatraman, that question was to you. Mr. Venkatraman, can you hear? Federal Bank, Mr. Venkatraman?
Yeah, I can hear you now, Mythili. Yeah. Morning.
Yeah, do you want me to repeat the question?
Sorry, I didn't get your question. Sorry.
Yeah, I'll just repeat it. I was asking you, how does the RBI's policy statement announced today affect a bank like yours? And are all banks in a sweet spot today, which is reflecting in their valuations? Because while on the hikes get passed on almost instantaneously on the lending side, because deposits are at fixed rates, contractual basis, the hikes get affected only the additional new deposits. So that puts banks in a particularly sweet spot. So two questions to you.
Yeah, I think firstly, just your point, the entire sector is, in my view, still having the tailwinds. So we will see a few more quarters of good growth in terms of the performance of the banking sector. But having said that, whilst there is a lag of deposit pricing to the loan pricing, what we need to keep in mind is whilst the credit growth is almost like 15, 18% and even around 20%, deposit growth is still half of it. So for banks to fund the growth, obviously they will have to price their deposits quite attractively. And that is where, even though you say that the new deposits command a higher price, we have seen that the repricing of the existing also happens where there's new money which comes in, which is good from the savers' point of view, which gets contracted at the higher rate. So eventually, over a period of time, in my view, probably a couple of quarters, you will see the gap between deposit pricing, loan pricing compressing further, and the NIMs will start reflecting that.
Okay, so that's a take coming in as far as the RBI monetary policy action is concerned. For now, we have the outcome in terms of the 35 basis point hike coming in on expected lines. The governor reiterating and stressing that Indian economy is faring much better than rest of the globe. Growth is not really a concern, even though they have cut down the FY23 estimate to 6.8% versus 7% earlier. But inflation is something that continues to be sticky, and that's why they say that they are going to take a calibrated policy action as is needed to anchor
and
inflation.
keep Arjuna's eye focused on that.
Absolutely. But with that, it's a wrap on the coverage of the RBI policy action. To all the guests who joined us, thank you so much for joining the markets at the lowest point of the trading session. When we come back, we'll talk more about the markets.